Welcome back to Options Trading for Beginners. In our first three videos, we've covered the basics of call and put options, the concept of the option premium, and the key components of an option contract, including the strike price and expiration date. Today, we're putting all of that together to deconstruct an option's total value. Every options premium, the price you pay for the contract, is made up of two components: intrinsic value and time value. Understanding this breakdown is fundamental to becoming a successful options trader. Let's start with intrinsic value. Intrinsic value is the immediate, tangible profit you would make if you were to exercise the option right now. It's the minimum value an option contract can have. An option can never have a negative intrinsic value. For an option to have intrinsic value, underlying asset's price must be favorable relative to the strike price. For a call option, this means the stock price is above the strike price. For a put option, this means the stock price is below the strike price. It can be calculated by a simple formula. For a call option, intrinsic value equals current stock price minus strike price. For a put option, intrinsic value equals strike price minus current stock price. If the result of this calculation is negative or zero, then there is no intrinsic value. Let's look at some quick examples. Imagine a stock XYZ is trading at $55. A call option with a strike price of $50 has an intrinsic value of $5. This is because if you owned this contract, you could exercise your right to buy the stock for $50 and immediately sell it in the open market for $55, making an instant profit of $5 per share, which is a total of $500 for a standard 100-share contract. Now let's look at a put option. Put option with a strike price of $60 on that same $55 stock has an intrinsic value of $5. You have the right to sell the stock at $60. Since the market price is only $55, you could buy it for $55 and sell it for $60, also making an immediate profit of $5 per share. What about a put option on that same stock with a strike price of $50? Since the stock is at $55, there is no immediate profit to be made by exercising the right to sell at $50. No one would choose to sell a stock for $50 if they could sell it for $55 on the open market. So this option has no intrinsic value. The total premium for these options, however, would be more than their intrinsic value, which brings us to the second component of the premium, time value. Time value, sometimes also called extrinsic value, is everything else in an options premium besides the intrinsic value. It's the amount an option buyer is willing to pay for the chance that the option will become more profitable before it expires. We can calculate time value using this formula. Time value equals option premium minus intrinsic value. The time value is influenced by several key factors, which we touched on in our video on the option premium. The two most significant are time until expiration and implied volatility. The more time an option has until it expires, the greater its time value, because there's a longer window for the stock to move in a profitable direction. As the option gets closer to its expiration date, its time value erodes, a concept known as time decay, which we'll explore in detail with the Greek theta. Higher implied volatility also leads to more time value, because it reflects a higher expectation of large price swings, increasing the probability of the option becoming profitable. Now, let's tie this all together with the concept of moneyness. Moneyness describes the relationship between the underlying stock price and the option strike price. There are three states of moneyness: in the money, at the money, and out of the money. An option is in the money if it has intrinsic value. For a call option, this means the stock price is above the strike price. For a put option, this means the stock price is below the strike price. These options are more valuable because they have a tangible, immediate profit component. An option is at the money when the stock price is exactly equal to the strike price. An at the money option has no intrinsic value, its entire premium is made up of time value. It's an option on the cusp of becoming profitable. Finally, an option is out of the money when it has no intrinsic value. For a call option, this means the stock price is below the strike price. For a put option, the stock price is above the strike price. An out of the money options premium is also composed entirely of time value, and it carries the most risk because a significant move is required for it to become profitable. Why is this so important? Because it provides a framework for understanding risk and reward. In the money options are more expensive because they have intrinsic value, but they also offer a higher probability of profit. Out of the money options are cheaper because they have no intrinsic value, but they are also much riskier. So they require a significant move in the underlying stock to become profitable before expiration. At expiration, if an option is not in the money, it expires worthless and the entire premium is lost. In our next video, we'll dive into the role of volatility in options trading and discuss why implied volatility is such a critical concept for every trader to understand. Thanks for watching, and I'll see you in the next video.